Felix here. There are 5 founder-led companies that are so freaking good it should be illegal. I'm going to show you not just which ones they are, but actually why they're good. I'm going to give you the data. You can analyze it all for yourself, or you can just pummel me with questions. If you want to learn also how we make more money, not just with long-term investment, which is what this is about, but also with shorter-term trading in just 3 or 4 hours a week, come and join my free live trading training. My mission is to make 1 million people financially free by sharing what I learned as a banker. Come and join me. It's going to be fun, and it's going to be way simpler than you think. felixfrenz.org/webinar. Let's get cracking, shall we? Stock numero uno, MercadoLibre, and it was founded by Marcos Galperin, who's a freaking genius, who isn't really, well, he should be really famous. I don't know why he isn't. He should be very famous. And look at these data points. Let's have a look at this. Cash flow is out of this world. Brilliant. It's growing like mad. Profits are insane. And relative value at C, you might be thinking, oh, that's crap. Well, normally for a profit health of A, you get an E or an F. This is a C. This is really, really good. This is actually, it doesn't look expensive. Let's have a look just how expensive it is. If you don't know what they do, it's sort of a, to say the Amazon of Latin America is a bit of a strange sister statement, but it's basically something a bit like that. They also have a fintech platform. It's a really, really cool business. And have a look at their margins. Almost 60% gross profit margin. That's pretty good for a basically retailer. It's become very profitable. Return on invested capital is 16%, which is a number that I love. And long-term profit growth, 25%, is insane. I combine these two, and that's my thumb in the air. This is how much the stock's going to go up by per year in the long run. Now, of course, it's not going to happen every year in the same way. This isn't financial advice. I'm not telling you to run out and chuck all your money at this by YOLOing into one of these, but the numbers are pretty freaking exciting. And look at that. Revenue, 13 billion. That's almost 30% growth year on year. And free cash flow is 4 billion. That's almost a 30% free cash flow margin, which is just extraordinary. And it just means that it's a brilliant business. It's incredibly well run. They generate more money than they know what to do with. Therefore, think buybacks, dividends, never any dilution. It's just a really, really good business. And they pretty much always beat earnings expectations just very, very, very solidly. Okay, 2021. All right, different story. And is it expensive? Yeah, it ain't cheap. At 76x, it's sort of in the range of a Tesla or something like that. It seems a little insane. But if you just follow the miserable analysts out there from Wall Street, well, they're saying how it's going to grow. They're going to saying it's going to grow 46% next year, 33%, 39%, 37%, 34%. They're pretty okay on growth. That will take your multiple down to just 5x. How does that work? PE, right? Price, earnings. Earnings is profit. Price is fixed because you pay for it today. And the profits keep going up and up and up and up and up and up. So over time, your PE multiple just gets lower and lower and lower, and you end up owning a really, really cheap stock. That's the theory, right? Next one. Synopsys, founded by Art de Geus. Is it de Geus or any what is it, Dutch? Any of you folk out there? Tell me how to pronounce it in the comments. And look at this. Cash flow, brilliant. Profit health, brilliant. Growth health, brilliant. Price momentum, relative value, okay, it's not cheap. It's not cheap. Let's have a look. So what do they do? Well, design automation, design IP, software integrity. It all sounds terribly boring and technical and nitty-gritty. IP solutions for PCI Express and MIPI, HDMI, Bluetooth. But they're making money. Their gross profit margin is a beautiful sunny 80%, just like their headquarters in California. They have a 17% return on capital employed and a profit growth rate of 17%. So I take those again and I go, bingo. That's meant to be a positive thing, maybe a smiley. Revenue has been exploding. Profits been exploding. Is it cheap? Well, what do you think? Revenue, 5.8 billion last 12 months. Free cash flow. I like companies with free cash flow. You might start to see a little bit of a pattern here of what I like, right? Free cash flow. We like free cash flow. No dilution and consistently beating Wall Street's expectations again and again and again and again and again and again. It's also what we like to see. It means management's on top of stuff. Is it cheap? Not really. 41% PE. But you know what? Really great companies just aren't cheap. But still, over the next 4 years, that almost halves in terms of PE. The analysts all fell asleep going through the data because it's such a dull business that we haven't got any expectations for the years after that, which is a bit odd, but it does happen for slightly smaller companies. So there is one. Then we got Ken Xie. He looks like a lovely, happy, friendly chap, doesn't he? He looks very happy. Fortinet. And I've talked about that before. It's a company that I like. Growth health, ching, profit health. Oh my God, how good is that, man? Cash flows, so-so, but it's also not super expensive. And that's, of course, what we like. Cybersecurity is the name of the game here. And if you're thinking about hacking, well, hacking is a thing. You know when these guys set up the business? 2000. You're going to love that. You're going to love businesses that were set up in 2000 when the dot-com thing collapsed, and they're still here, and they have a 76% profit margin, 15% long-term earnings growth. I don't know why the return on capital numbers were discontinued, but they'll be pretty good. And they're making 1.1 billion profit out of 5.3 billion revenue. You get the idea. This is a pretty good business. And free cash flow, 1.7 billion. More free cash flow than profit. Hallelujah. That's what we want. That's exactly. And consistently beating Wall Street expectations on profits, which is what we really care about. So very, very nice business. Dig into it a little bit more. Is it cheap? What do you think? 40 times PE, but you hold on to that thing for 10 years, just with current analyst expectations of slowing growth, you get to a 9x, which is much better than, slap in the face. Oh my God, it's Alex Karp. How did you get into this presentation? Another founder-led business, Palantir, and look at the numbers. Look how much better these have gotten. Remember, this is a growth stock when I was like, they're not making any money. They're hardly growing. Cash flow health. Growth health. Ching, price momentum. That means it's expensive. So yeah, it's expensive right now. Wait a little bit. See what happens. It's a very volatile stock, but there are things we can do with it. Watch my last Palantir video. I'll show you a trade and a 80% gross profit margin, long-term earnings growth rate, 30%. Return on invested capital is kind of nonsense here because they've only just started to become profitable, but they will become more and more profitable. And the numbers are going to start to look really, really sweet on this one, I think. And $700 million free cash flow. They're promising us $1 billion free cash flow this year. Share-based compensation, the dilution is 450 million. So you got 450 million dilution and the opportunity to buy back double that every year just from the current cash flow thing. So dilution is going to disappear, which is, of course, glorious. Been beaten. Yeah, they've been pretty consistent. Pretty consistent. Zero is still zero. So things are about to kick off there. That's my feeling. Is it cheap? Nope. 75 times PE, but that's also because we've only just become profitable. If you held onto this thing for 10 years, you'd get to 17, and that's on the basis of a bunch of miserable frickin' Wall Street lot who don't understand what Palantir does in terms of revenue growth. I think they do a lot better than that. I think this thing is going to become a lot cheaper. Here's one more. Chad Richardson from Paycom. Now, Paycom has insane profit and growth health. It's not super overpriced, which is why I added it in here. And it's basically HR, digital online cloud HR. That's how I would say it. And it's from hiring, applicant tracking, background checks, tax credit services, labor management, time and attendance, scheduling, all the really interesting stuff, payroll, tax management, all that kind of boring stuff that people in HR throw themselves out of the window for every day. This is all going to become AI. So I like where these guys are positioned. Gross profit margin at 86% is about as great as you can possibly get. 26% return on invested capital is like a wet dream for investors, and long-term earnings growth at 10%. It's pretty solid. I think that's going to improve. I think AI is going to make that possible. I also think AI is telling every CEO out there, get rid of the sad and depressing and overweight HR team of yours and put them on steroids with Paycom. So I think they're going to do very, very well. If you look at the numbers, revenue 1.6 billion here in the last 12 months, and 300 million of that's free cash flow. So again, it's a very, very well managed business that has consistently beaten Wall Street expectations on profits. So good management. And that's what happens when you got founders in there. Is it cheap? It's not insanely expensive. It's 25 times PE. And you hold that for 10 years or a little bit less, you get to 8.5. That's not 10, is it? That's 2, 4, 6, 8, 9 years. That's what I thought. You probably get to six times PE. You hold on to this thing, and they might grow a lot better than that. I think they probably will grow a lot better than that. So I quite like it. That's where my presentation ends. If you enjoyed the video, you know what to do. There are buttons you can abuse and comments you can leave, things you can share, abuse you can write at me down below in the comments. I'd encourage you to take 90 minutes out of your week and come and learn with me how we made 100% plus return on capital employed for each of the last 2 years with this method, felixschwenzer.org/webinar. I'll teach it to you for free. Thanks for watching.